So welcome to Stu-C TV friends. This is a lecture on CAB paper 1 ABM, and the topic is very important. We are going to discuss balance sheet. So the basics of balance sheet. Some of you might already know about it from your JAB exam preparation, but still we are going to revise these concepts and it is important for CAB as well. Let's start. What is a balance sheet? Balance sheet is a financial statement shows assets and liabilities. So liabilities and assets. And in liabilities, you will also have a section called owner's equity. So when you are understanding balance sheet, you should remember that it is just a summary of where money is coming from in a business, money comes from, and where it goes to. It is a simple explanation. On one side, you will see where the business has got fund from. It can come from liabilities, they can be from banks, NBFCs, or other third parties. Then another source of fund is owner's equity. This is from business owner. He invests his capital. Shareholders, if they buy shares, that will be part of owner's equity. So it can come either from the business owner or from outsiders like banks. So left side is all about where money comes from, and right side is where it goes to. Where it goes to, it will be used for buying assets. The money is going to be spent on assets. Assets can be different assets, fixed assets, current assets, etc. We will see those items in detail. And the format you should remember, it will be always mentioned the top of the balance sheet, there will be company name, XYZ Private Limited, and then as on when it is, what is the date of the balance sheet, 31st March 2025. So this format you will always see. Now the core idea is this: assets equal to liabilities plus owner's equity. Assets is equal to liabilities. Liabilities again can be split as outside liabilities and then those contribution by the owners. It will be called owners equity, common stock, shareholder earnings. All those things will be formed part of owners equity. So simple example, if you have an asset of, if you want to buy an asset of 3 lakh dollars, suppose you are buying a house of 3 lakh rupees or dollars, how will you get money from for this asset? You will get it from a housing loan, mortgage loan or a housing loan. From there you will get 2 lakh 40 and remaining you will make a down payment. So this is your own funds. So now this is a balance sheet. You will have housing loan, that is liabilities, and then own contribution, and together you will create this asset from that fund, house worth 3 lakh. So this is why the equation always balances assets equal to liability plus owner's equity. This is a fundamental equation, very important from exam point of view and for numericals. Now, what a business owns, now assets, we are going deep into assets. It will have current assets, fixed assets, and investments. Assets are basically used for generating cash. That is the ultimate purpose of a business, generate cash. So current assets are those which are generating cash next 1 year. Within 1 year, they'll generate cash. That will be your inventory, your raw materials, your debtors, or your cash itself, bank balance. All that, those assets will generate cash within 1 year. Then you have fixed assets like buildings, machines, land, which you are buying because you want to generate cash for long term. In the future, you will get benefit of that. And finally, you have investments, which are another way of getting money, not from the business itself, but investments like deposit or buying shares of other companies, etc. Now, current assets, these are short term resources, generate cash within 12 months. Examples are marketable securities, account receivables, inventories, and prepaid expenses. You can pause the slide and read them in detail. I'll just stress upon account receivables, debtors. Account receivables are nothing but the those items which for which you have already delivered your service or good. For example, a customer, he had ordered suppose 1,000 rupees of goods from you, and now when you have delivered goods, he has told you that now immediately he will pay 200, remaining 800 he needs some time. So those customers become your debtors, and that money becomes receivable. So it is called account receivable. But the business is hoping that in 12 months time or whatever is operating cycle, in that time it will be converted into cash. The customer will give it, but we record it as receivables. Okay. Similarly, you have prepaid expenses. Prepaid expenses is any expense you are paying in advance. So expenses normally come in P&L statement, but if you have paid something in advance, for example, insurance premium for next year you have paid now itself, so that will be shown as an asset till it becomes an actual expense for that particular year. So prepaid expense is part of current assets. Other things you can just pause the video and read. Fixed assets, as we discussed, it can be land, building, plant, and machinery. There is another category called intangible. This will be copyrights, trademarks, patents, brand value, goodwill, etc. This will be intangible. And tangible, land, building, plant, machinery, etc. So always note that in balance sheet, when we are writing down assets, fixed assets, we will show it net of depreciation. There will be some erosion in value due to use, age of the asset, etc. So that will be reduced, and that net of depreciation value will be shown. For intangible assets, this depreciation is called as amortization. Liabilities is again what a business owes. It can get funding from, as I said, owners or outsiders. Outsiders will be long-term liabilities, and then can be current liabilities. So this will be repaid within 1 year. So business has got money for immediate handling of business, day-to-day management of business, and this has to be repaid back to the banks or creditors within 1 year. It is current. And long-term liabilities are long-term loans of the business. So in current liabilities, we can have CC, OD, etc., and short-term loans, short-term borrowings. And most of your long-term loans will be in long-term liabilities, and which has to be repaid more than 1 year. Just like we had accounts receivable, we have account payable or creditors for the business. So business always has somebody called as supplier who will give raw material or inventory to the business. Raw material or inventory for starting the business. So when you start a business, you will suppose get inventory worth 1 lakh rupees. Now this 1 lakh you will not have immediately. So in that case, you will tell the supplier that I will give you 10%, 10,000 now, remaining 90,000 I will give you once I receive income from my sales. Let me sell all my inventory, then whatever money I will get within 2 3 months, I'll pay you back. So again, you are taking a credit from the supplier. So he becomes a creditor, and that amount becomes account payable. It is a liability, it is a current liability. You have to pay it within 12 months. Then other things you can just read: provisions, unearned revenue, long-term debt, current portion. Unearned revenue is important. Suppose a customer pays you in advance. You have not given him service or goods, but he is paying you in advance. So in that scenario, it will not be recognized immediately. It will be shown as unearned revenue in current liabilities. And when you actually deliver the service or goods, it will go to your P&L of that year, and it will be shown as sales. So provisions is always a thing in current liability section. If the business is keeping some money aside for future loss or future expense like tax, so then you will call it provisions shown as current liabilities. I hope this basic distinction is clear for you. Long term liabilities, you can just pause and read. It is long term obligations. Honest equity, it will have capital or stock or shares, and reserves from profit and loss statement. Whatever profit you're earning, you can transfer this to reserves if you want to reinvest the money in business.